One of the greatest benefits of investing in real estate is the tax benefits. And being able to claim depreciation is the biggest part of those benefits. Now, you may know what depreciation is, but is that a free pass to pay no taxes at all? Not quite. In this video, I'm going to reveal to you the hidden truth that most investors don't know about depreciation. It's really important to understand this if you're investing in real estate, so let's get to it. I'm Dan, an active real estate investor with hundreds of apartments, and I'm on a mission to help immigrant professionals grow their wealth passively through real estate. If you'd like a free copy of my guide, How to Get Started in Passive Real Estate Investing, just click down below in the description. So why does real estate get such preferential tax treatment by the US government when comparing it to things like stocks, bonds, and other types of investments? It's because the government wants us to invest in housing, because housing is key and propels the economy forward, plain and simple. And the people that make the economy grow are entrepreneurs and investors like you and me. Now, before I go any further, I am not a real estate CPA. So please talk to your own accountant to make sure what I'm describing applies to you in your unique situation. And be sure you have a CPA that understands real estate taxes. I can't tell you how many times I've met CPAs that know general tax advice, but don't know real estate very well. You really need somebody that understands real estate to be able to take advantage of all the things that are available to you as an investor. So I assume that if you clicked on this video, you probably understand what depreciation is. But in an effort to leave no one behind, let me just define it briefly. Depreciation is a certain monetary value that you can deduct from your real estate over time due to wear and tear. It's known as a paper loss because it's not really a loss per se. You're not losing money. It's simply an amount that you apply against your rental income when you do your taxes that usually negates a large portion of the profit, leaving a smaller or even no profit at the end of the day, which is amazing because that means you don't pay taxes on that. But again, this is only on paper. You could actually be making very good income from your property. I suggest you think of depreciation as a loan because the US government does expect you to pay them once you sell your property, hopefully for a profit. As I walk through an example, this will make a lot more sense. And an important note here, this entire discussion applies just as equally to real estate syndications as it does to rental properties. So let's dive into an example. All right, so let's say you bought a rental property, say for $500,000, which had $10,000 of closing costs. You made $40,000 worth of improvements over the next year to that property. And then 10 years later, you decided to sell it. You found a buyer willing to pay $650,000, which is great. And during those 10 years, you claimed traditional straight line depreciation, like most people do. So let's first talk about what the cost basis is for this home. And that's really a term that the IRS uses to establish the value of your home at a certain point in time. So at the date of purchase, this home would have a cost basis of $510,000 because that's $500,000 purchase price plus $10,000 in closing costs is $510,000. Now, the improvements that we talked about of $40,000 will happen over the first year or two, so they're not realized yet. So this is the cost basis. Now let's calculate your depreciation. We said the initial purchase price was $500,000. And the land value, we're going to estimate at $75,000 or 15% of the purchase price. Now, the exact percentage may vary depending on where you are and your CPA, but let's just assume that for now. So the home value is $425,000. That's what you can depreciate. So if you take that $425,000 divided by 27 and a half years, which is then the amount of time that you can actually depreciate a real estate asset like this, and your annual depreciation would be $15,400 roughly. I rounded it to make it easier. And this number was calculated using straight line depreciation. We took the $425,000 divided by 27 and a half years, and we came to that amount every year. So that's called straight line depreciation. Now let's assume now we're 10 years in the future now, and we're about to sell this property. So we have to find out what the adjusted cost basis is. We talked initially that the cost basis was $510,000. And now after 10 years, there's a new cost basis. the adjusted cost basis. And the way we calculate that is we start with the initial purchase price of $500,000, like we talked about before. We had $10,000 in closing costs. The improvements made were $40,000. That definitely added to the value of the property. But over 10 years, we claimed $154,000 of depreciation, which, as I mentioned before, is kind of like that paper loss. So we depreciated the building $154,000, that property. So the adjusted cost basis is $396,000. And this amount is what the IRS looks at to say what is the value of that property in their eyes based on what you've done to the property and what you've claimed in your taxes. So here's the adjusted cost basis of $396,000, which we just talked about. We mentioned also that we were selling this property now 10 years later for $650,000. So $650,000 minus $396 is $254,000 that is taxable. Now, when I didn't know this, I would have thought differently. I would have thought, well, I bought the house for $500,000, and if I'm selling it for $650,000, then that must be what I'm taxed on. But no, that's not the case. You're actually taxed based on the adjusted cost basis versus the sale price, which is a larger number. And this is something that most people just don't know. And I want to make sure that you understand as you're getting into real estate investing. And what makes things a little bit more complicated is that this tax is just not calculated by multiplying it by a certain percentage, this entire amount here, and that's your tax. It's a little bit more nuanced. Let me explain. That delta between the adjusted cost basis and the sale price is divided up into two segments. One of it is what's called the capital gain. And this is actually the profit, the true profit you made on that property when you sold it. And the rest of it is due to depreciation. The act of the US government wanting to get your taxes back from that depreciation that you utilize over those 10 years is what's known as depreciation recapture. And this is something about depreciation that is just a fact. That's just part of what it is. So you have $100,000 of capital gains, which are taxed at the capital gain rate. And then you have the $154,000 of depreciation recapture, which is taxed at ordinary income rates. So it's a little bit different between the type of income you're making here when you go to sell the property. And this is a thing that most investors just don't know. Now, that's probably more taxes than you thought you would have owed, right? I know when I first learned this, I was surprised. So the magic question here is there a way to avoid to pay all those taxes when you sell this property? And as a matter of fact, there is a way. It's done through what's called a 1031 exchange. And it's called this because it's the section of the tax code where this came from. A 1031 exchange allows you to defer the tax liability to another investment property, which is super cool. So there are three very important rules when it comes to a 1031 exchange. Now, there's other rules as well that are involved with it, but these are the three big ones that you should know about. The first one is that the replacement property must be of equal or greater value than the one being sold. So for example, you can see the little picture up here, selling a house and buying a small apartment complex. There's probably, it's probably worth more than the house is. That's an example of stepping up. You could also identify two properties that when put together are more than the first one. So there's some leeway in there. The second point is that the replacement property must be identified within 45 days of the date of sale of the previous investment. Now, 45 days is not a lot of time. So most seasoned investors are looking for properties well before the point they're going to be selling. So they've got some idea of some potential properties they can slot into the space to meet that 45-day period. And the third is that the replacement property must be purchased within 180 days of the date of sale of the previous property. So that's roughly 6 months, not exactly, but it's around that amount of time that it must be closed. And if it's another home, it's probably no big deal. But if it's a commercial property or something larger or more complicated, that can be some tight timing. So as I mentioned, there are other things related to a 1031 exchange that are sort of rules that you need to follow. But these are the big ones that you really need to know if you're thinking about potentially getting into this. Real quick, if you're finding value from this video, please share it with somebody else that you think might find value from it too. It's from word of mouth from viewers like you that will help spread this message to other immigrants. Now back to the video. So while it is a little bit complicated, you can do a 1031 exchange as many times as you'd like, and it's not that difficult once you get the hang of it. One of the downsides of a 1031 exchange is that if you do end up deciding one day, you know what, I just want all that income from the sale, then you're going to have to pay a lot of taxes. But there is a way around this. Tax liabilities end with death. So if you die without selling the property you obtained through a 1031 exchange, then your heirs are not going to be expected to pay the tax that you postpone paying. They'll inherit the property with all those tax deferments wiped clean. This means that a 1031 exchange can be a really important tool in your estate planning, and is one of the big reasons why we say that real estate can lead to generational wealth, because this can be passed on to other generations. Now, as I mentioned at the start, these concepts all apply to real estate syndications as well. I wanted this video to have a very simple example so you could understand the basic concepts. But in a future video, I'll talk about how this all pertains to real estate syndications. So if you're wondering, what is a real estate syndication? Don't worry, I created a video right here where you can learn all about it and why it's such a great way to invest in real estate passively. So what do you think? Let me know in the comments, and thank you for being here today on the Immigrant Wealth Channel.